If you are a business owner and you're not sure about how to be paying yourself or the tax implications of taking money out of your business, there's a good chance that you're not doing it right. And let me tell you that these mistakes can be expensive and an administrative nightmare to correct. One that comes up is you are an S Corp and you don't put yourself on payroll. That is a bright red flag for the IRS. I have heard that the IRS has computerized systems that when you file your 1120S for your S Corp, there is a line specifically for officers' compensation. If you are an owner, there's a good chance that you are an officer. And it will read that form, and if there are certain conditions that are met. At the time that I had heard this, I was taking a class that was taught by somebody who used to be in the small business unit at the IRS, and she said, you know what? If it is $7,000 or less, automatically pulled for review. If it is $7,000 to this dollar amount, somebody's going to look at it. So don't mess around with that, because what happens, oh, this is ugly. Let's say you took $100,000 out of your business and you took no salary. The IRS can come back and say, you know what? 60% of that $100,000, that's payroll. And we're going to recharacterize it. And because we're always super behind, you're not out of statute. You can't amend your return. And we're going to charge you penalties for back payroll taxes and back late filing related to this payroll for those 4 or 5 years. And you have to go back and amend your return. So nothing's deductible because you can't go back and fix your returns, and you're swimming in penalties. So don't get into that trap either. So let's walk through some examples. We're going to talk about single member LLCs, multi-member LLCs, S corporations, and C corporations. And if you hang out until the end of the video, I'll tell you which entity type is best suited for the type of activity you might be in. All right, we get another whiteboard session here. Love those. So we're going to start with our single member LLC. And this is our most common for people who are just getting into their business and are not ready to take on the complexity and overhead of something more structured. So this is an entity. You set it up with the state. Again, this is an entity. You set it up with the state. You've got the liability protection, but for tax purposes, this is an entity that is either owned by one person or a husband and wife. And so for federal tax purposes, the IRS says this entity doesn't exist. If you were a sole proprietor, you would report on a Schedule C. Everything would be subject to self-employment taxes. The IRS says, you know what? Go ahead and keep doing what you were doing. You were doing such a great job. Usually additional tax filings with the LLC, it's going to be at the state level. So how do you pay yourself in this entity? Now let's go back to if you were a sole proprietor before your LLC, you recognize that from an accounting standpoint, yes, keep those separate bank statements, separate set of books, all that. We love that as accountants. But for tax purposes, everything in the LLC is yours. And so no payroll here, no like taxable distributions, because what happens is as this entity makes money, you personally are going to be paying taxes on it. Therefore, all the dollars in the LLC are already taxed. And so when you take them out, it's just what we call a return of capital. These are after-tax dollars. So no tax implications, because again, you're incurring the tax implications as you generate the income. So for this one, if you want to pay yourself, you just take money out of the bank account. Now, if you do have a separate set of books and you are doing accounting, thank you. We love that. This would be considered an owner distribution. There's no need to do not put yourself on payroll. And I say that very wholeheartedly, and I'll tell you why in a second. But easiest example, single member LLC, you own everything in this business. You are paying taxes as the company generates profits. Therefore, it's all yours, no tax implications when you take the money out. Okay? Now, let's change this to say, now brothers, we've got 6 partners. We've got, more than one member to this LLC, not husband and wife. So now we have a multi-member. And for these purposes, now the IRS says you have a technical partnership. So this now has its own filing requirement. It's going to do its own tax return, And now this entity, because there are multiple owners that have a vested interest in this, essentially we're hoping that, economically partner A put something in, partner B put something in, partner C put something in. Now we're keeping track of all of that. Partner put in after-tax dollars. We're going to keep track to make sure that partner doesn't take out more than he has put in or paid taxes on. So this is where, if you were at this point, I really want you to have a set of books, because keeping track of partner capital can get very confusing and does have tax implications. So again, this entity does not pay taxes itself. You're going to do the separate 1065 filing. Each owner is going to get their distributive share of net profits, and that's going to show up on a K1. Now, the tax treatment of that is going to depend. So our first example, let's say that that this is a service business, and partner A, maybe we'll put this on the whiteboard. Partner A and partner B, two different things here. Let's say partner A is the primary service provider. They're coming in, they're generating the revenue, and they own 50%. Let's say partner B is an investor. Partner B is like, you know what? I really believe in you. I'm going to light your business up. I'm going to put in capital, and I'm going to take 50% ownership. So as partner A is providing services to generate revenue, partner A is going to take what's called a guaranteed payment. This is not payroll. This is not getting subject to payroll taxes through the company. What's going to happen is partner A is going to report two types of income that's coming off of his K1. One part of it is going to be this guaranteed payment, subject to self-employment taxes, and then his 50% ownership of the profits, again, subject to self-employment taxes. Now, partner B is just our investor here. So partner B, what they're going to report is 50% of the profits. Okay, so how do you get money out of this business? Two ways. Partner A, like we talked about, is performing services. Partner A gets a guaranteed payment. The other way is to take distributions. And so either of these partners could take distributions, and what we are looking for them to take ideally is what they initially put in and their percentage of profits, because again, all of that has already been taxed. They put money in with after-tax dollars, they pay taxes as the business generates income. So when they take it out, it's a tax-free return of capital. Now let's say that they start to take out more money than they put in, and it is a distribution. Now we're subject to capital gains. So this is why partnership basis becomes super important to keep track of. All right, so let's talk about some horror stories. I had a guy, one of these really clever guys. I know how this works. He was in a multi-member partnership, and he was like, I'm going to put everybody on payroll. We're all on payroll. Took payroll for 18 months. I told him not to. Oh, yeah. No. We're going to do this thing. It's going to work out. Never did the thing. It didn't end up working out. And so we ended up having to amend 18 months of 940s, which is the quarterly filing, or I'm sorry, the 941s are the quarterly filings, the 940s are the annual filings. We had to amend W-2s, and there was a big old chunk of change of payroll taxes that the business had paid in that now needed to be recouped. It tied up a lot of cash. And what's worse is that each of these partners had kind of thought, oh no, I've been paying taxes. I've been paying taxes all year. Now we've taken this deduction, we've reverted it. It's not a tax deduction because they should have never been on payroll. And now they haven't been paid in throughout the year for their taxes. So that was awful. Don't do that. And that is specific for your LLCs, single member LLCs, sole proprietors, multi-member LLCs. Do not put yourself on payroll. Okay. So let's go on to the next one that we will inevitably have in this, and that is the ever so popular S Corporation. Now, the S Corporation is a tax status. So this is an LLC or a corporation set up with the state that has made an election with the IRS and, the respective state that says, tax me as an S Corporation. Now, in this business or in this entity structure, what we're going to have is net income from our activities we are going to have wages. Then we're going to have our taxable income. And then we're also going to have this concept similar to the partnerships. We're going to have this basis concept where we're keeping track of what the shareholders have already paid taxes on and determining whether when they take money out of this business, it's taxable or subject to those capital gains. So starting at the top, again, this is a pass-through entity. It, on a federal level, will file a separate tax return, but it is not paying taxes itself at the federal level. But the IRS has said that the earnings from this business, this is subject to payroll taxes. This is not. So the tax savings here is that where in the sole proprietor, the single member LLC, the multi-member LLC, all of the earnings were subject to self-employment taxes. Here we're going to split it up. Here, only the wages that are taken through payroll are subject to payroll taxes. 50% is going to be a deduction to the business. 50% is going to get paid by the employee, just like every other payroll. But what's left over is just going to be ordinary income. And that's awesome. So taking money out of this business, two ways. We're going to take money out through wages, and we're going to take money out through shareholder distributions, which is going to affect this little basis bucket. And again, because we are recognizing the taxable income on our personal returns, and we are paying taxes as, in theory, as the company is making money, when we take money out, there's a bucket of money in there, hopefully, that has already been taxed. And so it is a tax-free return of capital. Now, an example, this is where we get into trouble, is let's say owner A put in $50,000. We've got year one earnings of $10,000. So we've got $60,000. So owner A, $60,000 in. Now let's say they're like, we're going to do this big expansion. We're super excited. We're going to go get a line of credit of $100,000. If we turn around and we say that this owner then takes out $75,000, that owner is now using this capital to fund that distribution because he's only got $60,000 in here. So now he's using debt to finance that. And the IRS is like, So now what we have is we have a $60,000 return of capital. And that is going to be non-taxable. And then down here, we're going to have $15,000 that's subject to long-term capital gains. So it's, again, really important once you get into this area that you have a set of books, because this shareholder basis becomes really, really important. Likewise, when you're operating your business throughout the year, I mean, there's nothing saying that you can't use business funds to pay for personal expenses. What I want to emphasize is if you do that, the accounting needs to reflect that. So if, hey, I accidentally put, my Target purchase on my business credit card, no worries, let me know, or keep track in your accounting, and we will say, hey, this Target purchase, it's coming out of my basis. It's coming out of my after-tax dollars. Okay, last one. And that is the C Corp. Boop. So again, this entity is a separate legal entity. This entity has shareholders. This entity does pay taxes. This entity pays taxes at a flat 21% as of 2026. The way we get money out of this business, a little different. Wages and dividends. So similarly, wages, you're getting paid for services. You get a W-2. That W-2 has got payroll taxes withheld on it. The employer, C Corp, is paying their half of the payroll taxes. Now, here's the other thing that happens. As you take money out of the business, it is first coming out of profits. And those profits are subject to tax. So the corporation is going to pay taxes. And then as the earnings are paid out via dividends, the shareholders are going to pay taxes again. And you might have heard this concept of double taxation in regards to corporations. This is it. So C corporation pays taxes on profits. Dividends are not deductible. And so when they're paid out again, shareholders pay taxes. Which entity is best for who? And I would say that if you are just starting your business, you don't have a clear path, you're not quite sure, you're still kind of testing the waters, I'm going to say stay in a sole proprietorship. If you are not in a, a litigious field, I'm going to say if you're doing anything that relates to construction or medical, anything where you feel like there's a threat that you could be sued, maybe pull the trigger on that LLC. Because what is common is that people think that LLC provides tax benefits and they're like, I set up my business, I got my LLC, I'm ready for taxes. It's like, as we saw from that example, the LLC does not change the tax status for you if you are the only owner. It is treated exactly the same as if you were a sole proprietor. So don't get the LLC until you are concerned about your personal assets. If you think that there's, you have a store, you're worried somebody's going to fall into your store and they are going to take your personal home, maybe get the LLC. They're, relatively not that expensive for the liability protection that could be provided. Once you get into earnings where you are like, I'm doing this, I am going to be committed to doing this business for the next couple of years. I'm making $80,000 to $100,000 a year. Net income consistently, I'd say definitely start to look at that S Corp because you are going to save on payroll taxes. And you are going to, if you are in a state that has the pass-through tax election program, the pass-through entity tax program, California has one. I want to say New Jersey has one. I'm a California CPA, so that's the one I know. Virginia has one. Some of the higher income states have these programs that will allow your business to pay your personal taxes for you. That is another strong pro for making the S election. So if you're in that income range, you don't mind taking on a little bit more compliance with today's technology. These systems are so easy to use. They're really not that much of a heavy lift, and you could save yourself $10,000, $15,000 pretty easily. I'd say definitely look at that S election. In fact, I have a little survey that if you fill out this survey, it'll give you some guidance. It'll say, based on your income levels, you should consider this and you should consider that. And check out these resources. And I'll put that link in the description. Lastly, the C Corp. I don't work with a lot of C Corps. I feel like the C Corps are really best for people who want to scale on a large level and bring in a lot of investors. So if you're looking to have shares that can be, if you're somebody who wants to be acquired, if you're like, I'm going to go public someday, having that C corporation could be the right structure for you. Outside of that, from a tax perspective, I know we all get really excited about like, oh, it's a fixed 21%. I'm over here paying 37% on the individual level. But if you think about it, if your corporation's paying 21%, and best case scenario, you're paying 15% on those dividends, you're paying 36%. Again, you could be a corporation and have the liability protection that a corporation provides, but have that S election sit on top of it. And so if you are a corporation that has defaulted to being taxed at the corporate level, then I'd have to assume that it's because you're looking to scale and bring in a lot of investors. But hope this was helpful. This has got to be one of the number one things that I get questions on. Well, it's all number one in my head because I get talked to so much. But I get clients all the time that are like, oh my gosh, I'm an LLC now. I need to put myself on payroll. It's like, no, you don't. Or I have people who have S Corps that feel like they can't touch the money in the business because belongs to the business. And we have to have a conversation where it's like, well, actually, it's all yours because you're paying taxes on it. So it's really just about understanding how you get money out of the business and then making sure the accounting reflects it. And really it's, hey, there's owner's distribution component to the business, which completely makes sense. I get clients a lot who are like, how am I supposed to pay the taxes on my business if I'm only taking this much in salary? It's like, have your business pay the taxes. The business incurred the revenue and the income, so just have the business pay your personal taxes. We're just going to call it a shareholder distribution if you're in an S Corp. All right, hope this was helpful. I'm going to put the link in the description if you want to take that S election survey. And I also have a free online community that is meant to connect founders. This is one of the hardest things I've ever done, and it's really hard to find people who understand why I do it. I had a boyfriend who was like, why don't you just give up your businesses and get a government job? And it's like, you don't know me at all. Because I would rather struggle than settle, and the government feels like settling. Anyhow, I would love to invite you to my community so that you can connect with other founders, bounce ideas off of other people who know what it's like to be in the trenches, wearing all the hats, what things are working for them, what things they've tried and it sucked. So I would love to connect with you. I want to hear your struggles. I want to hear your wins. I want to be your biggest cheerleader and your biggest resource. So I'll put a link to that as well.